Hello friends, welcome to Premier UPSC IAS. So today we are going to study about all the important terms and concepts from the economy subject of the UPSC Prelims examination. And these slides are made in a precise manner. All the important points pertaining to that topic are only taken. So we are going to read it first, and a smaller explanation would be enough because already the slides are very precise in nature. So let's dive into it. First term is absolute poverty. The term itself tells what it is, but let's see. Poverty defined with respect to an absolute material standard of living, is called as absolute poverty. Someone is absolute poor if their income does not allow them to consume enough to purchase a minimum bundle of consumer goods and services, including shelter, food, and work clothing. An alternative approach is to measure relative poverty. Moving forward, Aadhaar Payment Bridge System, implemented by National Payments Corporation of India (NPCI). So basically, Aadhaar Payment Bridge System is implemented by NPCI, that we have to remember, used by the government department and agencies for electronic transfer of benefits and subsidiaries under Direct Benefit Transfer Scheme. So this Aadhaar Payment Bridge System, which is implemented by National Payments Corporation of India, is used by all the government departments and agencies for DBT, that is Direct Benefit Transfer Scheme. Uses the Aadhaar numbers issued by UIDAI and IIN, that is Institution Identification Number issued by NPCI. So in this system, it uses both UIDAI, that is Aadhaar number, and IIN, that is issued by the NPCI. IIN, that is Institution Identification Number, is a unique 6-digit number issued by NPCI. So Aadhaar number issued by UIDAI, that we know already. But the IIN is issued by NPCI to every APB system participating bank, that is Aadhaar Payment Bridge System participating bank, and is used to uniquely identify a bank to which the APB transaction has to be routed in the Aadhaar Payment Bridge System. So it is used in order to participate the bank into this payment bridge system. We are talking about IIM. Okay. Moving forward, ad valorem tax. An ad valorem tax is a tax based on the assessed value of an item, such as real estate or personal property. The most common ad valorem taxes are property taxes levied on real estate. However, ad valorem taxes may also extend to a number of tax applications, such as import duty, taxes on goods from abroad, etc. Ad valorem taxes are generally levied on both real property and major personal property, such as a car or a boat. So basically, it is a assessed value of an item that is called as ad valorem tax. So that tax, it is based on the assessed value of an item, especially in real estate or personal property. Personal property could include car or boat or etc. Okay. Agricultural census. Next term, agricultural census, which is conducted every 5 years in India. It is the largest country-wide statistical operation undertaken by Ministry of Agriculture. So, from the statistical point of view, it is the largest country-wide statistical operation undertaken by Ministry of Agriculture for collection of data. So, even the data is collected by the Ministry of Agriculture when it comes to agricultural census. So, one might get confused, like when it is census, it could be by any census board, okay, for collection of data on structure of operational holdings by different size classes and social groups. Primary fresh data and secondary already published data on the structure of Indian agriculture are collected under this operation with the help of state governments. The first agricultural census in the country was conducted with reference year 1970-71. Agricultural census is carried out as a central sector scheme under which 100% financial assistance is provided to states or union territories by the central government. Agricultural census operation is carried out in 3 phases. Altcoins. let's see what are altcoins. Altcoins, they are alternative cryptocurrencies. So they are alternative cryptocurrencies that were launched after the Bitcoin success is called as altcoin. So alt coming from alternative. They generally project themselves as better replacements for Bitcoin. Bitcoin's emergence as the first peer-to-peer digital currency was paving the way for many to follow. Most altcoins are trying to target any perceived drawbacks that Bitcoin has and come up with the competitive advantages in the newer versions. So that is about altcoins. Basically, it is an alternative cryptocurrency of Bitcoins. Moving forward, let's see what is angel fund. What do you mean by angel fund? So, angel funds refers to a money pool created by a high net worth individuals or companies. So basically, it is a money pool created by a high net worth individuals or companies, generally called as angel investors, for investing in business startups. So this is a type of fund that is referred to a money pool basically by a high net worth individuals, basically rich people who are basically investing. They are subcategory of venture capital funds with strict focus on startups. While venture capital funds generally invest at a later stage of development of the investee company in the later stage, basically. But in India, the term angel funds is defined in SEBI, that is Alternative Investment Funds Amendment Regulation 2013. Angel fund is defined as a subcategory of venture capital fund and category 1 alternative investment fund that raises funds from angel investors and invests in accordance with the rules specified in Chapter 3A of SEBI Amendment Regulations 2013. Angel fund can raise funds only by way of issue of units to angel investors and should have a corpus of at least 10 crore rupees. So minimum corpus is 10 crore issue of the units to the angel investors. Okay. Let's see what is angel tax. Angel tax was introduced in the 2012 budget by the then finance minister to arrest laundering of funds. So basically, angel tax is to arrest the laundering of funds. So there was illegal laundering of funds going on. So financial minister introduced this one in 2012. Misuse of the incentives given to the startups was the main factor that tempted the government to impose tax on fresh investments over a fair price of shares. Technically, angel tax is an income tax. So, angel tax is similar to income tax payable on capital raised by unlisted companies from the investors. So, the companies are unlisted, that we have to remember. From investors, mostly angel investors, via issue of shares if the sold share price is excess of the fair market value of the shares. It is popularized as angel tax by the business community because such investment is usually a main fund mobilization channel for startups that are mostly unlisted entities. So that is all about angel tax. Moving forward, annual financial statement. Budget, the constitutional term for budget is annual financial statement. The annual financial statement is a document presented to the Parliament every year under Article 112 of the Constitution of India, showing estimated receipts and expenditures of the Government of India for coming year in relation to the revised estimates for the previous year and also the actual amounts for the year prior to it. The receipts and the disbursements are shown under three parts in which the government accounts are to be kept. One is consolidated fund, two is contingency fund, and three is the public accounts. Under the Constitution, an annual financial statement has to distinguish expenditure on revenue account from other expenditure. Government budget, therefore, comprise of revenue budget and capital budget. The estimates of this kind of distinction is specifically under the Constitution. That is also an important understanding when it comes to annual financial statement. The estimates of receipts and disbursements in the annual financial statement are shown according to the accounting classification prescribed by Comptroller and Auditor General of India. So such a receipt and disbursement is basically shown according to the CAG of India under Article 150 of the Constitution. So that kind of a rule is also written in Constitution, which enables Parliament and the public to make a meaningful analysis of allocation of resources and purposes of the government expenditure. Moving to asset turnover ratio. Most of the times the word itself is self-explanatory, but let's see. The asset turnover ratio is a ratio between the value of a company's sales or revenues and the value of its assets. So it is the ratio between the value of company sales versus asset. So the sales or revenue is being compared with the value of its assets of the company. That ratio is called as asset turnover ratio. It is an indicator of the efficiency with which a company is deploying its asset to produce the revenue. So it basically shows how the assets are being used properly to produce the revenue from the company. So it is about the estimation of assets. Hence the name asset turnover ratio. Thus, the asset turnover ratio can be a determinant of a company's performance. The higher the ratio, the better is the company's performance. Asset turnover ratio can be different from company to company. Usually, it is calculated on an annual basis for a specific financial year. Generally, a low asset turnover ratio suggests problems with surplus production capacity, poor inventory management, and bad tax collection methods. The problem with low asset turnover ratio means there is problems with surplus production capacity, poor inventory management, and bad tax collection methods. Low margin industries always tend to have a higher asset turnover ratio. Moving forward, bailouts. Let's see what is bailouts. Bailout is a general term for extending a financial support to a company or a country. Nowadays, this term is very commonly seen in the news because of most of the countries like Sri Lanka and Pakistan are being bailed out, and IMF is they are pursuing the IMF for the money. Okay, so bailout is a general term for extending the financial support. So extending the financial support to a company or a country facing a potential bankruptcy threat. It can take the form of loans, cash, bonds, or stock purchases. A bailout may or may not require reimbursement and is often accompanied by greater government oversight and regulations. The reason for bailout is to support an industry that may be affecting millions of people internationally and could be on the verge of bankruptcy due to prolonged financial crisis. So that is the main reason behind the bailout. The bailout policies come in various forms. The most common being direct loans or guarantees of third party private loans to the rescued entity. These direct loans are often on terms favoring the entity being rescued. Sometimes even direct subsidies are provided to the parties concerned. Stock purchases are also not uncommon. Bailouts have several advantages. First, they ensured continued survival of the entity being rescued under difficult economic circumstances. Secondly, a complete collapse of the financial system can be avoided when industries too big to fail started to crumble. The government in these cases steps in to avoid the insolvency of institutions that are needed for the smooth functioning of the overall markets. Bailouts also have their disadvantages. Anticipated bailouts encourage a moral hazard by allowing not only the promoters but also other stakeholders, that is, customers, lenders, and suppliers, to take higher than recommended risk in financial transactions. This happens because they start counting on a bailout when things go wrong. Balance of trade. Let's see what is the meaning of balance of trade. The difference between a country's import and its exports. Balance of trade is the largest component of a country's balance of payments. Debit items include imports, foreign aid, domestic spending abroad, and domestic investments abroad. Credit items include exports, foreign spending in the domestic economy, and foreign investment in the domestic economy. Those are the credit items. Okay. A country has a trade deficit if it imports more than it exports. The opposite scenario is a trade surplus, also referred to as trade balance or international trade balance. So that is all about balance of trade. Bank rate. Let's see what is bank rate. Bank rate is the rate charged by the central bank for lending funds to commercial banks. So central bank will give funds to the commercial banks at a rate. That rate is called as bank rate. Bank rates influence lending rates of commercial banks. So because they are taken from the central bank, so this rate will also influence how the commercial bank is going to lend. Higher bank rate will translate into higher lending rates by the banks. In order to curb the liquidity, the central bank can resort to raising the bank rate and vice versa. So, in order to curb the liquidity, so in order to stop the flow of money, central bank is going to raise the bank rate, and in order to increase the flow of money, central bank is going to increase the bank rate. That is the opposite effect. The Reserve Bank of India determines the bank rate. The rate is changed from time to time, but it does not mean that there is already a set schedule for it. So there is no time period, but it changes from time to time. The rate at which the repo rates are changed depends entirely on the prevailing economy. Moving forward, Banking Ombudsman Scheme. The Banking Ombudsman Scheme was implemented by the RBI to redress the complaints of customers on certain types of banking services provided by banks and to facilitate the settlement of those complaints. So basically, this banking ombudsman scheme is about addressing the issues of the complaints of the customers on certain types of banking. So it's the kind of customer complaint service. The scheme was introduced under the Banking Regulation Act of 1949 by RBI with effect from 1995. So even though it was introduced in 1949, well, it came into effect from 1995. Later, it was legally refined and modified through the introduction of regulations under the Banking Ombudsman Scheme 2006. The later revision was made in 2017. So the revision of the Banking Ombudsman Scheme after 2006 came in 2017. The Banking Ombudsman actually is a senior official appointed by the RBI. So basically, he is a official appointed by RBI to redress the customer complaints against the pitfall in the stipulated banking services covered by the Banking Ombudsman Scheme. All the scheduled commercial banks, regional rural banks, and scheduled primary cooperative banks are covered under the Banking Ombudsman Scheme. So, scheduled commercial banks, SCBs, regional rural banks, RRBs, and scheduled primary cooperative bank, that is urban commercial banks, are covered under the scheme, that is Banking Ombudsman Scheme. Very important. Banks Board Bureau. Banks Board Bureau is an autonomous advisory body. So basically, it is advisory body and it is autonomous in nature, created by the government to enhance the governance of the public sector bank, that is government bank, and state-owned financial institutions. The most popular function of the Banks Board Bureau is to recommend the whole-time directors as well as non-executive chairpersons of the public sector banks and state-owned financial institutions. So important function of the BBB, that is Banks Board Bureau, is it is going to recommend the directors of the non-executive, the whole-time directors and the non-executive chairpersons of the public sector banks and state-owned financial institutions. The Banks Board Bureau was created after the recommendations of the committee to review the governance of the boards of banks in India. Chairperson was P.J. Nayak Committee in 2014. Main objective of the creation of the Banks Board Bureau was to empower the boards of the public sector banks. It was created in February 2016 and started functioning from April 2016. It is an autonomous recommendatory body. A search committee. There is a search committee of in the PBB. This search committee, it includes the RBI governor also, and this search committee recommends the names for the appointment of BBB members. The six-member BBB panel has three government officials and three experts, of which two are from the banking sector. So that is about the composition of the BBB. Following are the main functions of the Bank's Board Bureau, that is BBB, responsible for the selection and appointment of board of directors in the public sector banks and the financial institutions, both whole-time directors and non-executive chairmen. Advise the government on matters relating to appointments, confirmation or extension of tenure, and termination of services of the board of directors of the above mentioned level, to advise the government on the desired structure at the board level, and for senior management personnel or for each PSB and the financial institution, to help banks to develop a robust relationship succession plan for critical positions that would arise in the future through appropriate HR processes, including performance management systems, to build a data bank containing data relating to the performance of PSBs, financial institutions, and its officers. So it also build a data bank, okay, to advise the government on the formulation and enforcement of a code of conduct and ethics for the managerial personnel in the PSBs, to advise the government on evolving suitable training and development programs for the management personnel of the PSBs and FIs, to help banks in terms of developing business strategies and capital raising plans. So all are the main functions of banks BBB. Okay. Moving forward, let's see what is base rate. Base rate is the minimum rate set by the Reserve Bank of India, below which banks are not allowed to lend to its customers. So here Reserve Bank is not lending, but Reserve Bank is actually fixing the lower level below which the banks should not lend to its customers. Base rate is decided in order to enhance the transparency in the credit market. So if there is a fixed base rate, all the banks should have to follow that lower level. Okay? So that will have the transparency in the credit market, and it ensures that the banks pass on the lower cost of fund to their customers. Loan pricing will be done by adding base rate and a suitable spread depending on the credit risk premium. So the loans, basically loan pricing is done by adding the base rate. Okay. Base erosion and profit shifting, that is BEPS. The BEPS, that is base erosion and profit shifting, it refers to tax planning strategies used by multinational enterprises that exploit gaps and mismatches in tax rules to avoid paying tax. Developing countries' higher reliance on corporate income tax means they suffer from BEPS disproportionately. So basically, this base erosion and profit shifting is tax planning strategies used by multinational enterprises. What they do, that exploit the gaps and mismatches in the tax rules to avoid the paying tax. Developing countries' higher reliance on the corporate income tax means they suffer from BEPS disproportionately. These BEPS practices cost countries US dollars 100 to 240 billion in lost revenue annually. Working together with the OECD and G20 inclusive framework on BEPS, over 135 countries and jurisdictions are collaborating on the implementations of 15 measures to tackle tax avoidance, improve the coherence of the international tax rules, and ensure a more transparent tax environment. So that is about BEPS, that is base erosion and profit shifting. Basel Committee on Banking Supervision, BCBS. The Basel Committee is a committee of bank supervisors consisting of members from each of the G10 countries. The committee is a forum for discussion on the handling of specific supervisory problems. It coordinates the sharing of supervisory responsibilities among national authorities in respect of banks, foreign establishments, with the aim of ensuring effective supervision of banks' activities worldwide. Let's see next term, that is Basel Capital Accord. The Basel Capital Accord is an agreement concluded among country representatives in 1988 to develop standardized risk-based capital requirements for banks across countries. The accord was replaced with a new capital adequacy framework, that is Basel II, published in June 2004. Basel II is based on three mutually reinforcing pillars that allow banks and supervisors to evaluate properly the various risks that banks face. These three pillars are minimum capital requirements, which seek to refine the present measurement framework; two, supervisory review of an institution's capital adequacy and internal assessment process; and market discipline through effective disclosure to encourage the safe and sound banking practices. That is called as Basel II norms. Let's see other term, beauty premium. The beauty premium refers to the incremental income that people who are physically attractive earn when compared to others who are considered less attractive. The beauty premium has been attributed by researchers to a variety of reasons, including psychological biases that affect the employer choices while hiring the workers. Workers and managers who are physically attractive may be considered more honest and competent at work than others. Some researchers, however, have denied the existence of the beauty premium in a labor market. They argue that wage differences can be explained by factors other than the physical beauty. Benchmark interest rates. SONIA is a short for Sterling Overnight Interbank Average Rate, weighted average overnight rate paid by banks for unsecured transactions in the British sterling market. So these are the names of benchmark interest rates in the world, among which the first one is SONIA. The full form is Sterling Overnight Interbank Average Rate in British. LIBOR. LIBOR is a London Interbank Offered Rate. SOFR is US, Ester is European Union, and Chonar is Japan. Before is the Mumbai Interbank Forward Offer Rate. MODI is Mumbai Overnight Derivatives and Interest Rates Future Indian Benchmark. Note, Indian businesses borrow dollars in the form of external commercial borrowings. The interest cost on these borrowings are usually linked to LIBOR. In fact, RBI's regulations on the external commercial borrowings also use the LIBOR to calculate the cost of loans. Let's see what is Bharat Bond ETF, the debt exchange credit fund that will hold bonds issued by the PSEs or by the government of India. Bharat Bond ETF is the first corporate bond ETF in the country going to be traded in the stock exchanges. It is a brand new investment product for the investors as well. The Bharat Bond ETF invests in AAA rated bonds of the PSEs such as REC, EFC, NHAI, etc. The minimum amount of rupees 1000 per bond and there is no maximum limit. But for retail investors, there is an upper limit of rupees 2 lakhs. Bharat Bond ETF offered a unique combination of assured return if held to maturity, beneficial tax treatment if held for more than 3 years, and liquidity if one needs to exit before maturity, as the ETFs will be listed on the exchanges. Call money rate. Call money rate is the rate at which short-term funds are borrowed and lent in the money market. So basically, it's about the short-term funds. The duration of the call money loan is 1 day. Banks resort to these type of loans to fill the asset liability mismatch complying with the statutory CRR and SLR requirements and to meet the sudden demands of funds. RBI, banks, primary dealers, etc. are the participants of the call money markets. Demand and supply of liquidity affect the call money rate. A tight liquidity condition leads to a rise in call money rate and vice versa. Call money market. The market where overnight there's one-day loans can be availed by banks to meet the liquidity. Banks who seeks to avail liquidity approaches the call market as borrowers, and the ones who have excess liquidity participate there as lenders. The call money market CMM is functional from Monday to Friday. Banks can assess the CMM to meet their reserve requirements, CRR and SLR, or to cover a sudden shortfall in cash on any particular day. Effectively, the call money market is the main market oriented mechanism to meet the liquidity requirements of banks. Capital accounts. So let's see what is capital account. Capital account can be regarded as one of the primary components of the balance of payments of a nation. So it is a primary component of BOP of a nation. It gives a summary of the capital expenditure and income for a country. The capital expenditure and income is tracked by way of funds in the form of investments and loans flowing in and out of an economy. This account comprises foreign direct investments, portfolio investments. It gives a summary of the net flow of both private and public investment into an economy. A capital account deficit shows that more money is flowing out of the economy along with increased its ownership of foreign assets and vice versa in case of a surplus. The balance of payments contains the current account in addition to the capital account, which records all capital transactions. Let's see what is capital markets. Um, Capital market is a market where buyers and sellers engage in trade of financial securities like bonds, stocks, etc. The buying selling is undertaken by participants such as individuals and institutions. Let's see what is carbon tax. Carbon tax is an environmental tax which is imposed on products which utilize carbon-based materials and hence contribute to the greenhouse gas pollutions, including oil, gas, coal, and other fossil fuels. The level of the tax should depend on the carbon polluting content of each material. Carbon taxes offer a potentially cost effective means of reducing greenhouse gas emissions. From an economic perspective, carbon taxes are a type of Pigovian tax. So the type is Pigovian. They help to address the problem of emitters of the greenhouse gases not facing the full social cost of their actions. Carbon taxes can be a regressive tax in that they may directly or indirectly affect low income groups disproportionately. The regressive impact of the carbon taxes could be addressed by using the tax revenues to favor the low income groups. Let's see what is CASA. CASA stands for current account and savings accounts, which is mostly used in West Asia and Southeast Asia. The CASA deposit is the amount of money that gets deposited in the current and savings account of the bank customer. It is the cheapest and major source of funds for banks. The saving accounts portion pays more interest compared to current accounts. Ceteris paribus. This commonly used phrase stands for all other things being unchanged or constant. It is used in economics to rule out the possibility of other factors changing, that is, the special causal relation between two variables is focused. Let's see what is central sector schemes. Central sector schemes are schemes with 100% funding by the central government and implemented by the central government machinery. The central sector schemes are mainly formulated on subjects mainly from the Union list. Besides, there are some other programs that various central ministries implements directly in states and UTs, which also come under central sector schemes. In these schemes, the financial resources are not shifted to states. Centrally sponsored schemes. The term itself shows, okay, that they are completely sponsored by the schemes to different states. But some part of that scheme will be also taken by state government.